Welcome to this Killik Explains Finance video. This week, 4 bond market signals investors should watch. 4 red flags. Get them all together, it's tin hat time. So what are they? Now, why are we looking at the bonds market? Well, in a nutshell, bond markets often signal good and bad news early, and they're thought often to be more reliable than, let's say, the equity market in doing so. That's because the cash flows on a bond can be modelled more easily. They're more predictable than on equities. Lots of big, bright people work in the bonds markets. So the so-called bond vigilantes scour the market, looking for opportunities to mark bonds down and up and spot difficulty. And they have a history of predicting things correctly. Now, not always. Nobody has a foolproof history, but they've been quite good in the past, not perfect, at predicting downturns. And I'll give you an illustration of that in just a moment. So, bond markets can be early warning indicators of trouble. So let's have a look at some things we'd look at. Now, key indicators: bond yields, yield curves, credit ratings, and credit spreads. Warning signs specifically would be rising bond yields, a yield curve that is flattening or even inverted, credit ratings getting downgraded, and credit spreads widening. So, a bit more on each one there. Now, bond yields, first of all. I'm not going to cover this in a lot of detail. Other videos do that in terms of the mechanics. But what I'm saying here is that basically bond yields are the total return on a bond as a proportion of its current price, and they're indicative of the way the market sees the bond. Because on a fixed income security, for example, if the price changes down, the yield, because the income's fixed, will rise, and vice versa. So these can be quite a good indicator, moving yields. Now, normally, rules of thumb would be short-term bonds usually, all other things being equal, yield less than medium term, which yield less than long term. Why? Because if I ask you to lock your money up for longer, you'll want compensation. And that's true of bonds as it is with anything else, a bank account, for example. Other things to think about are, all other things being equal, low-risk bonds will carry a lower yield than medium risk, and that'll be lower than high risk. All right, and we'll look at risk in more detail in a moment. As a rule of thumb, therefore, investors are looking at these things and saying, the more risk you want me to take, either in terms of the issuer, the bond, the amount of time you want to lock my money up for, that will all influence the yield. So, if yields start rising, you've been watching them for a while and you see them start to lift, could that be a sign that bond investors are marking bonds down? Why would they be doing that? Perhaps they anticipate a rise in interest rates. Could be a number of factors, but it can be a warning sign. But it's more powerful if it comes with some other ones. So, the yield curves, take a look at that one. Now, I cover this in another video in more detail, so here's a snapshot. The US Treasury bond yield curve is an excellent recession predictor, says the FT's Lex. Well, let's have a quick look at what it looked like relatively recently. So, the yield curve basically looks something like that. This is the US Treasury yield curve. So we've got short, medium, long dated again. This is government IOUs issued by, this time, the US Treasury, US government if you like. And we're seeing a slightly sort of upward sloping line, not a big gradient there, and then it kind of goes flattish. Now I might be thinking, well, so what? What does that tell me? It tells me that the yield on short dated is a bit less than medium, which is a bit less than long, which sounds sensible enough. But what gets people nervous is this kind of thing. If you were to plot the yield curve going back a little bit, December 2016, and going back a few years, December 2013, you notice something. The shape is changing. It's sort of moving like that, if you like. And that suggests it's flattening out. Now that's a bit weird, because if it gets flat, that would suggest the yield on short, medium, and long-dated bonds is the same. But didn't we just say that investors would demand more for holding long-dated bonds? Well, this is what people worry about. If you go to November 2006, the key on the chart there, you see something that looks like this. Now this is known as a sort of inversion, because it's basically downward sloping, if you like. In other words, this end is higher than the middle or the other end. And that suggests that all of a sudden the yield on short-term stuff is higher than medium and long-dated. And at that point, we were heading for trouble, the credit crisis, 2007, 2008. So some people would say the bond market signaled that when the yield curve inverted. Now, people debate how accurate the yield curve is as a predictor of trouble, but it's one of those things you can add to your tick list and say, if the yield curve is starting to flatten, let alone invert, history suggests maybe trouble ahead. People are abandoning their normal time preference for bonds and locking up yields, nervous about the future. Credit ratings, number 3. Now here's another one. So the basics, what are these things? They're issued by 3 large agencies, basically Moody's, Standard & Poor's and Fitch. They range from AAA, that's the highest rating you can get, down to D, and they're a reflection both of the issuer and the specific bond. So a company like Tesco can issue bonds with different credit ratings because it can issue them at different levels of risk, different yields and so on. Lower ratings, this is the key bit, generally correlate with a higher risk of default. So as you slide down from AAA, triple B, triple C and so on towards D, basically investors are saying, whoa, this thing's getting more and more risky, and therefore we demand a higher return for holding it in the form of a yield. That's your rule of thumb. So if you suddenly see credit ratings starting to change, ratings agencies getting nervous, as indeed Moody's did recently over the UK, for example, because these are issued on government as well as corporate bonds, maybe it's time to start looking around for other signs of trouble. Now, by themselves, you've got to be careful. These are opinions at the end of the day. They're opinions by very bright, intelligent people working for agencies, but they are opinions nonetheless. And they're voluntary. You don't find them on all issuers on all credit. So sometimes you can't compare like for like, if you like. And the three main agencies don't always agree on either the timing of a change or the extent of it. And they have little subtleties. They can change their outlook, for example, without changing the rating. So you need to get familiar with the language. And a cynic would say all of them missed, in one sense, the 2007-2008 financial crisis. Nobody ahead of that was marking down bonds far enough or fast enough. But that caveat aside, they're still leaned on pretty heavily as being a professional judgment on the quality of a particular bond. So if those yields start changing, you're not sure why, maybe it's time to watch out. Now, credit spreads. This is important. So, credit spreads represent the gap between the spread on something safe and something riskier. Something safe could be a government IOU, something riskier could be a corporate IOU. So, if you're comparing, let's say, two bonds, 10 years to maturity, let's say, medium-term bonds, one of them, so that's why the arrow is there if you like, one's got a yield of 6%, one's got a yield of 1%, then the spread, very crudely speaking, is 5%, right? 5% or 500 basis points. Excuse my scribbling, there's various ways of saying the same thing. So what? By itself, not a terribly exciting piece of information, but it's the change you want to monitor. Because if you see, basically it's a measure of relative risk, a bit difficult to see what I've written there, but it's a measure of relative risk, so we're saying the gap between the two bonds in yield terms suggests how much riskier one is than the other. If that happens, so if the gap widens, so the top one goes to 8, let's say, the bottom one stays at 1, so the spread is now 7 or 700 basis points, another way of saying it. What's that all about? Well, basically that is the market saying, watch out, the bond with the higher yield has got riskier relative to the benchmark. On the other hand, narrowing, that's people saying, well, actually, I'm prepared to hold one bond at a similar yield to another, so I don't see so much of a gap between the two. And that usually is a positive sign for corporate bondholders in that sense. So there you have it, basically, my 4 measures. And it's if you see them all together, watch out. So keep an eye on yields, what's happening to yields, the yield curve, how's it moving and how quickly, how are credit ratings behaving and what's happening to credit spreads. Get all of those moving the wrong way together and it's potentially tin hat time. Now, lots covered there. Editor at killik.com with questions, and to see videos that are a kind of backdrop to this one on some of those topics, killik.com/learn.